Hey, good morning, everyone. Welcome to today's macro snapshot. We are Thursday, January the 15th, 2026. Okay, I just want to start off with a quick review of a little bit of data and to see how we're going with the US economy in general. What we can see here is that we've got the US retail sales, which were yesterday. Now, the data collection, you can argue with the government shutdown, has still been less than perfect. Having said that, broadly speaking, it seems that the health of the US consumer in general, overall, is doing quite well. If we look at the headline number, you can see that was higher than expectations. Going back to November, so this data is potentially a little bit lagging, but nonetheless, it gives a bit of a snapshot. November was 0.6, which was higher than the estimate. You also see that the numbers excluding automobiles, which is an important kind of more of a core number, was higher than expected. You see here that was 0.5 versus 0.4, and you see that was going up. Then also in the super core number, the sort of control group, you can also see that that was, relative. There was not a beat, but it was a positive number at 0.4. So overall, retail sales are looking quite good. The other data which we got yesterday was the PPI. So keep in mind that we had a softer than expected CPI a couple of days ago. So the producer price input was also relatively good. We'll just find it here. We have that here somewhere. So, 0.2, that's not too bad in theory for the headline number. The core PPI was at 0, expected at 0.2. So the PPI for the core number, at least for November, was actually a bit lower than expected. So overall, it looks as though the economy in terms of retail sales holding up relatively strongly. The US consumer is doing okay. And it does seem as though inflation is maybe not perfect, not at 2%, but certainly not skyrocketing. So, enough to give the Fed, a relative amount of comfort. So looking at other things, we also had yesterday, we had the Beige Book, which was released by the Fed. And the Beige Book, of course, looks at the 12 different sort of districts all across the US, just sort of anecdotal evidence about the economy. And basically the key quote there was that the activity was flat or higher in 8 out of the 12 districts. So in two-thirds of the districts, economic activity was flat or even a touch stronger. So the point is no particular empirical evidence of a recession or sort of deteriorating conditions. So if we combine, the relatively benign sort of conclusions of the Beige Book, if we combine that with the relatively strong retail sales and the relatively acceptable inflation level, I think the conclusion here is that the US economy at the moment, with some of the data we're getting, is okay. It's not booming, it's not collapsing, it is chugging along quite solidly. Now we're going to get a bit more data this morning. We have initial jobless claims. What's expected is 215,000. And keep in mind that is absolute from a historical perspective. If we get something around about 210, 215, 220, that is absolutely not indicative of a recessionary sort of labor market. And actually, it's indicative of a relatively strong labor market. So we'll see what the number is. But basically, the 4-week moving average for initial jobless claims seems to indicate that the US labor market is solid. And if we understand that because of Trump's immigration policies, there's far fewer new entrants into the labor pool. And that basically means the replacement rate, so the number of new jobs necessary to be created. A lot of people, we had Kashkari yesterday, I think from the Fed, saying, maybe only 30 or 40, 50,000 new jobs need to be created for the unemployment rate to remain constant. And keep that in mind that historically, over the last, let's say, 10 to 20 years, that replacement rate of necessary new jobs which need to be created was maybe, sort of 100, 150,000. So the point is that the US labor market can remain stable because of less incoming immigrants with, 30 or 40,000 new jobs being created every year. Okay. So let's just talk about some other parts of the economy. And I just want to have a quick look, guys, just a bit of a sort of a data here, just a couple of interesting charts here on the credit card situation. Now, remember, when I say credit card situation, I'm talking about Trump's proposed a cap of 10% of on maximum credit card interest rates. And just it's interesting to see here that this is sort of a lot of the consumer financial companies who are heavily sort of involved in the issuing of credit cards or get a lot of their money from a credit card interest. And just basically looking here at the changes in their sort of stock price since Trump's proposal. And you can see here companies like Synchrony Financial, Capital One, even Visa going down, Citigroup, a lot of the banks, the American Express, MasterCard, a lot of these banks and consumer finance companies down, between, let's say, 5 and 13%. And the problem here is that, would and you just see the performance here. If we look at an index, just to put in the context, this is the S&P 1500 consumer finance, so relative to the sort of the broader index here, this S&P 1500, not 500. And you can see here that it's come down a lot. And basically the problem here is that the only people who would really benefit are people who are sort of, super prime. So, very good customers, generally the wealthier parts of the society, the richer people, people who are fully employed with good incomes. And you can see here that they basically always pay less interest rates. So you see this is going back to 2024, last year, for which we have full data here. And you can see here that people who are deep subprime, so basically credit risks, paying up to 25%. And basically the further you go subprime, near prime, prime plus, and super prime, you can see that overall, the situation with credit card payments favors those who actually need a revolving credit card the least in society. And so the problem is the pushback from the consumer finance companies is basically saying, hey, you want us to cap 10%, but that's not going to compensate us for the risk of the deep subprime and the subprime components in society. And in order for us to continue to provide credit for those consumers, we need to be adequately compensated, which means, rates, 15, 18, 20, 21% for uncollateralized credit. And they're basically saying, if the interest rate, the credit cards are capped at 10%, they'll either withdraw access to those consumers, or basically, the compensation will come in other forms. So less credit card points, frequent flyer points, annual fees will go up. So the point is that overall, a lot of these companies will say, well, either, sure, if the president insists on capping it at 10%, we will either withdraw access to those more vulnerable parts of society, or essentially sort of the fees will be sort of redistributed in, more expensive annual fees and whatnot. And not only that, the paradox here is that there'll be more attention on the super prime customers, the wealthier, the richer customers, because they'll be the ones who will be more courted, and the competition will paradoxically probably drive down interest rates on that prime plus and super prime component. So the point is here, I just want to say that there's been a big sort of pushback to that sort of proposal by Trump, and I'm not sure that's going to be going into law anytime soon. Probably Trump knows that, and it's just part of the messaging, the communication strategy from the White House, to essentially say that the White House and the Trump administration and the Republicans are deeply focused on affordability. So they're sort of putting out these things of 50-year mortgages, 10% cap on credit cards, all of these populist measures, which probably have no chance of actually being put into law, as I say, but it's more of a political messaging kind of situation here. Okay, so when we're talking about the stocks, let's just have a quick look. What's interesting, this clearly seems to be sort of rotation happening, and we can have a look. If we look at the equities, what's getting my attention? If you look at the MAGs, just look at the MAG 7 kind of ETF here. So this is MAGS MAGs, the Magnificent Seven. You can see here this has been underperforming a little bit and is relatively weak. So you say, well, okay, does that mean the stock market's going down? But if we look at the RSP, which is sort of the equal weight, you can see that's making new highs. So a clear outperformance here. So the depth of the breadth and the depth of the market is actually widening out to the detriment of the large tech stocks. But maybe that's no bad thing. And we actually see here, what I like to look at is the S&P 500, the stocks above the 50-day average, this percentage. And you can see how this is pushing up. If you go back to the lows in sort of at the end of 25 in terms of concentration, only about 35% of stocks on the S&P 500 were above their 50-day moving average. But you can now see that there's about 70% which are above their 50-day moving average. So that ties in with this notion that's been sector rotation, and it's going more broadly and away from some of those tech stocks, which is probably a good thing. Having said that, not all tech stocks are going down or anything like that. It's simply that is broadening out. So for example, in terms of the earnings, we had TSMC this morning. We had some very positive news out of the Taiwanese sort of semi maker. So they're up this morning. And just talking about that, you can look at global equities, and you can see something like, if we look at the KOSPI, for example, which is heavily sort of correlated to the semiconductors. So you look at the KOSPI index over in South Korea, just continues to rip higher. That's going higher and higher and higher. And so the semis are still sort of are doing very, very well. Maybe, rather than even sort of the Mag 7, the semis doing very well. And you can see that is, reflected in, indexes like the Kospi in Korea, or as I say, TSMC out of Taiwan this morning, which is doing very well. So let's keep an eye today on the semiconductor index. That's probably going to be boosted. Other earnings to keep an eye out for today, we have Goldman Sachs, we have BlackRock, and Morgan Stanley. So let's continue to see if they're doing well. So let's keep an eye today on the semiconductors, also on the bank index, and also on the banks, the individual bank stocks themselves. So just getting back to the equity market as well. Just want to have a quick look here and see what's happening in the equity. So you see here the ES. Well, actually, let's have a look at Nasdaq. You can see up 80 basis points. So had a bit of a down day yesterday, but you see fighting back quite strongly this morning. Nasdaq, probably part of that is on the back of TSMC's positive sort of earnings and outlook. So the Nasdaq up. You can also see ES up 34 basis points. Not as much, but still doing quite well. Russell up 20 basis points. And again, this whole idea that the small caps and the equal weight is outperforming the big boys, so to speak, the ES and the Nasdaq. So you can see here the Russell pushing up towards highs again. So very strong. Now, where could this go? As if we do some measured moves here. Let's just look at the Russell. We'll put it on a Fibonacci extension. So if we do this one anchored on the 21st of November, you can see here that the Russell, the measured move, there's more juice in this. It could go up to 2,700, 2,750, 2,800. There's no problem there in terms of where that could go. And one of the reasons for that is that volatility. Let's have a broad look at the volatility regime. If we look at the VIX, VIX yesterday spiked up to about 18. But you can see that was pretty short-lived. There's geopolitical tension in Iran and whatnot. So I think there was a little bit of geopolitical tension underlying some of that spike in the VIX. But you can see here this morning, as we're talking here, we're down to about 16 levels. So the implied move, over the month, that's about 1% on a daily basis. So that's a reasonable. There, the VIX here at about 16, which is implying a move of about 1% today. Having said that. We also want to keep a look at some other sort of volatility. Obviously, something like silver vol. If we look at silver volatility going absolutely nuts. Now, silver volatility up at 86, 87. So, very difficult to be trading this, especially, if you want to be sort of long, sort of gamma or vega volatility, that's going to be very, very expensive. So you need to be putting in some kind of selling volatility at some point. That's a difficult one. So obviously in the precious metals, we also look at gold volatility, not nearly as bad as silver volatility. We're also seeing oil volatility having a spike yesterday. So in the commodities volatility, especially silver and oil, have been quite elevated. But what's actually interesting, if you look at the MOVE index, which is the volatility of the general bond market, you can see that the MOVE index is essentially like the VIX, obviously, for bonds. You can see that's going straight down. And that's basically good for equities, because what equities does not like, apart from higher yields, equities also don't like volatility in the bond market and the speed of moves. And so the fact that the MOVE index, bond volatility, is at very low levels, 57 historically is at a very low level, that broadly speaking is going to be a tailwind, a benefit for the equity market. So the point being here is that for sure, there's going to be some daily headline, chaos caused by Trump and maybe geopolitics and individual news about NVIDIA chips being sold or not sold to China. But the reality is that the broader market for volatility is relatively subdued, acceptable to the equity market. And the broad bid, the relentless bid for equities will continue, or should continue, in my humble opinion. And we could see the S&P 500 also testing highs, who knows, in the next day or two. We'll keep an eye out for earnings, but overall, there's no particular headwinds at the moment for the equity space. Okay, just quickly want to look at a couple of other markets here. Obviously, you can see silver here had a big down day yesterday. Now, I'm not going to go into a lot of the details, but as we see, volatility is extremely high. There's actually not that much open interest if you look at the US COMEX contracts or you look at the Western-based ETFs. Really, a lot of the inflow is in the sort of the Chinese market, the futures market over in Shanghai, and also Chinese ETFs for silver. There's a lot of underlying sort of, as I said, volatility here, a dealer sort of hedging and whatnot. So the point is here, I'm not even going to say that this is a sell-off in a sort of a classical sense. I think there's just volatility. And as you can see, already bouncing back quite strongly. So silver at this point, can it get up to $100? Absolutely. Gold is also doing pretty well. Gold is a more orderly market, but as you can see here, it's above or its moving day, sort of EMAs, exponential moving averages, well above even the 20. The measured move still measures out to something in the high fours, 48, 4,900, maybe even up to 5,000 over time. Copper itself, if we just have a quick look, not BTC doing actually quite well. Yeah, you see BTC just while we're there, over the 100-day moving average, breaking out again. If you look at a Fibonacci potential measured move for the BTC contract, you can see here that BTC, in a certain sense, is achieving the upper end of its measured moves. There's overhead resistance here, horizontal resistance at about 99,000, and then we have the 200-day EMA at about 100,000. So it looks to me like that 100,000 is a nice round number, nice juicy target there, which would also be the completion of the full measured move and the 200-day moving average. So that's kind of a nice one for the algos to be aiming at. As I say, I just wanted to have a look at copper here. Copper also, doing nothing particularly wrong, had a bit of a sell-off yesterday in sympathy with silver. But essentially, it was bought at the Fibonacci retrace level at the 38% fib. You can see here at about 5.9 that was bought. And so the bull's still doing quite well, well above all the moving averages. The big hurdle now for copper, for those trading it, is going to be the 6.11, the 6.10 level, which is overhead resistance. But if we can get through that, you've got to say that there's quite a lot of blue sky overhead, so to speak, and copper could definitely push out a little bit higher. The other market, obviously, is oil. Very, very choppy. You see here that on the oil contract, we were rejected at that sort of recent high. So very key overhead level at about 62.35. You see that rejection yesterday. Above the 200-day moving average, it achieved, but now sort of pushing back down to the 100-day moving average. So a pretty nasty sort of a sell-off. And if I put that on a 15-minute chart, which will give you a little bit more granularity, you can see here very, very volatile, really being headline driven. So pushing up, there's that level where it was rejected. But basically, a lot of this was just on the news coming out of Iran, and the fact that Trump was saying that there was a possibility, keep on going, patriots of Iran, help us on its way. So this idea that maybe the US could intervene militarily or with a cyber attack or some kind of other kinetic intervention, that hasn't occurred. And then Trump basically came out with this fairly bizarre headline at about 3 p.m., as you can see, which was this huge, the initial catalyst for the fall, which has continued, oil has continued to fall. But the initial catalyst was the Trump headline essentially saying that he heard, quote unquote, that the Iranian authorities were going to sort of shoot less people on the streets and that they wouldn't execute too many more people. And the market has taken that fairly grotesque headline to be meaning that Trump was satisfied that the regime was acting in a morally correct way, and therefore there'd be no need for intervention, and therefore the possible disruption to supply would not be as great. Anyway, oil going down. Now, keep in mind, just we're looking at fundamentals as well before we finish on oil, that we had the Department of Energy numbers out yesterday, and they were sort of higher than expected in terms of the build. So just structurally, there is still plenty of oil in the world. And so the thing in Iran, the elevation of oil prices is tied to the potential for disruption in Iran. And as soon as that dissipates, so does the need for oil prices to go higher. And so the thing now is where does oil go? I mean, it's going to be headline driven. Who knows? Maybe today we'll get another headline or military intervention. But just sort of on a technical level, I'll put it on a 4-hour chart here. And what I would say, the key sort of technical level to be looking at, probably we can look at just some of these fib retracements here, and you can see here that we already have breached the 38% fib if we just look at this sort of shorter term sort of level. But I would say the key level is probably going to be around about 58.30 on the front contract, because not only is that sort of a horizontal resistance, but it's also sort of the last stand for the bulls, because that's the 61.8 fib retracement there. So personally, I think that if oil gets down to 58.45, you could argue that there's still scope for the bulls to take that and buy the retrace. But if it breaches on the downside 58.45, I think there's definitely a little bit more downside there, and we could go down back into the mid to low 50s. Okay, guys, I will leave it there. I've spoken too much. So have a great trading day. Let's keep an eye, as I said, out on some of those tech stocks, the semiconductors, the banks. Keep an eye out on initial jobless claims. And obviously, let's keep an eye out for headlines in terms of oil. And in a broader sense, also the precious metals will, silver, keep its relentless rise going. Thanks very much. That's it for today. And we'll see you tomorrow with the macro snapshot. Thank you.